All right, hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker, and with me today, I'm excited to have my friend and a private investor, as we're calling him today, Jeff Moore. Jeff, how's it going?
Good. How about you, Andrew?
Doing good, man. Hey, let me start this podcast the way you do every podcast, and that's by pitching you. I've known Jeff for years. For those of you on the YouTube, I was teasing him before. We met in person a couple years ago, and at the time, he was rocking a real mountain man beard, and I'm a little disappointed he's not giving that to the YouTubers today. But he's one of the sharpest and quirkiest microcap investors I know. His Ethinex trade, it was Ethinex, right? The bankrupt company?
Yeah, me and Thomas Brazil did that. Yeah.
Say again?
Me and Thomas did that. Yeah.
Yeah. I mean, that one is the stuff of absolute legends. People can go read the backstory on your blog, Ragnar is a Pirate. We've got Jeff to thank for the activism in the old SiteStar and whatever Enterprise Diversified is becoming. So, whenever Jeff pitches a microcap, it's worth paying attention. So let's dive into the microcap that it's probably more than a microcap. I guess this is like it's still a microcap. It's like, 600 million market cap.
For me,
the microcap, go ahead.
For me, it's huge, right? I mean,
they say size doesn't matter, but let's dive into talk we're going to talk about today. The company is Thryv, THRY, and why don't we just jump in it? You can give us an overview who they are, why you're attracted to them.
Yeah. So I guess there's a couple of ways you can look at it, but ultimately it's two very unique businesses that are kind of combined into one, and the first one is not exciting. So if you want the letdown first, listen to this part, or maybe just skip ahead a couple minutes to the exciting part. But the first part of it is basically a legacy Yellow Pages business, right? They sell, well, they don't even sell, they really give away phone books, like to hotels, gas stations, stuff like that. And, as you can imagine, it's a melting iceberg of a business, as they refer to it. It did something like $1 billion in revenue last year. Who would have thought? But, for these phone books that they pass out, they take in something like $9.50 in revenue from people advertising, like, in Kentucky, like Dawn Howard Plumbing or Roto-Rooter would advertise it, right? Or, even landscaping companies. A business partner of mine, her brother, he advertises Builder in there, right? And he probably gets, a couple $1,000s in bookings from it a year for, $100 in expenditure or something.
Wow, that's crazy ROI.
Yeah. So it works out for them. And, the actual cost to print one of these books and get it into a location is like $1.50 or something like that. So they're looking at it. It's like 90% margins on phone books of all things, right? They also do some SEO stuff and marketing services and things like that. So, that's kind of compelling. They can really help with search results and whatnot. And do some really interesting things with that. So anyway, that's a melting iceberg of a business. It's going down, low 20s in the percentages. I think last year it did like 24% decline in revenue, but they had some COVID credits where they were, helping out some businesses and whatnot. And if you wouldn't, and I think it was like 17 million bucks or something they gave it that. So, 22, 23%, I think is what you'll probably see going forward, which coincidentally, like you'll kind of see with a particular rural ISP that's a micro cap that we all know. That business is declining at 20% a year, like clockwork, and has been forever, pretty much. But it cash flows like crazy, because who would think that email addresses that people pay, $5 a month for or whatever, have 90% profit margins for the company, right? So that's the melting glacier, really, I would call it. Then they had a bankruptcy in like 2015 or so.
Yep.
2016. Reorganized, and that's kind of one of the interesting parts of the play that I'm in, which we'll get to in a little bit. But they started a SaaS business that's also called Thryv. That's called Thryv, and they renamed the whole company after that to kind of show the transition of the business. And so this is a software that's really made for small business, and it's fantastic software. I've got experience with it. Like, we actually signed up as resellers for it to learn more about the product and kind of how that works. And we got, a contractor on it that I know. He loves it, loves it. And we're going to be getting some more businesses on there. My HVAC guy was already on there. I know a garage floor coating guy who I bought some townhouses off of his dad. It turns out he uses Thryv for that as part of a franchise he has, which you'll hear Joe Walsh talk about the franchises that use the software. He loves it. So it's just a great small business software. And the beauty of it is its simplicity. I mean, I genuinely think that it is boomer proof. If you have trouble emailing, you'll be able to use Thryv. And they've done a really good job of making it very simple, which is not something that, Salesforce or HubSpot or, Service Titan, something like that is. Those are complex systems. I mean, I would have trouble navigating those, and I think I'm a little bit tech savvy. But the simplicity of it is its beauty, and that helps it roll out to small businesses, and they can implement it very quickly. They've got onboarding widgets, they've got onboarding staff that help you, and they're really good about checking in with you, because ultimately, as soon as you start using more features of it, you're locked in. I mean, it's just like this iPhone, right? The first iPhone that you get, you're not locked into the ecosystem, right? But if you get an iPad or an Apple Watch or a MacBook or anything like that, or a HomePod, you are stuck in the Apple ecosystem forever. And it's a similar thing with some of the SaaS software.
So Jeff, if I'm a local plumber, Thryv Software I could use. Can you just exactly, you say a plumber uses the software, but there's a lot of different things a plumber could use the software for. So what solutions is Thryv specifically going to give plumber, that your HVAC friend or whatever? Like, what is their software solution looking to do? Just so people can see, are we talking email solutions? Or are we talking, pricing jobs? Like, what are they doing?
Well, a little bit of everything. The sky's probably more so the limit than there being limitations by the software, right? So in the example of my HVAC contractor, if you would Google HVAC Lexington, Kentucky, right, there'll be, dozens of results that pop up. But if you go down below the paid ads, which will be Comfort Systems, I think Greenbox will probably pop up. Mr. HVAC is right below that. And that's sheerly because he's using the Thryv SEO platform. He pays, I think, $200 a month for it, and he pops up very high on those search features, or at least he does for me. And it may be because I've got Riffet's cell number in my phone, and there's cookies.
No, you know what? I just Googled HVAC Lexington, Kentucky. First thing that pops up, Home Advisor advertisement, HVAC pros. Second thing, best 10 HVAC it's the Yelp page. Third thing is expertise.com. Fourth is Stivers HVAC. Fifth thing, as you said, Mr. HVAC, Lexington, Kentucky.
Yeah. So he pays nothing for advertising. Zero, right? That's sheerly the Thryv software that he pays $200 a month for. And what that does is it links up all the business hours of services, the reviews, everything like that. So it aggregates data from like 40 sites, like Facebook, Yelp, Home Advisor, Angie's List, all these other places, and it makes a consistent internet presence amongst all the platforms, which is huge. I mean, this is like literally the way that a lot of these small business contracting firms work specifically, and this is true for a lot of small businesses. But if you can get any internet presence and get it to be halfway decent with something like Thryv, like it's like being in an ass kicking contest with a one-legged man, as Charlie Munger says. I mean, you were so far ahead, just automatically. And so that's one of the big things from it. Other things that it can do. I'll say the most exciting for last. So let me write it down so I remember to say it. But it has scheduling. They can set up a website for you, right? Where like you just kind of enter in stuff. Like what's the company that kind of halfway did that Yahoo acquired for a bunch of money a while ago? Tumblr.
Tumblr, okay.
Yeah, I mean, so it's almost like that, right? They prefab these websites for you. They get your hours consistent. They can do scheduling. So let's say that you have estimators, right? You can put in schedules online, and then it'll link up with the website, and then you could say, hey, I'm good at 4:30 p.m. on Tuesday the 18th, or whatever. They'll know to come out. It follows up with text messaging. It gets everything in an inbox. It gets all the messenger apps and stuff to work together. It sends appointment reminders. I mean, as a real estate investor, a big problem we have is tenants not letting plumbers in, or plumbers not getting the right info or something. So it can link up people and be like, hey, we're on the way, make sure to be there to let us in. You can put together.
I guess, the Thryv software, what it's going to do, it's not going to do your accounting, right? So that's going to be more QuickBooks or something, handling all
QuickBooks. Yeah,
it links up to it, but it's not an accounting, but it's more a customer relationship management, CRM, and it handles all of your internet presence, I guess is what it said. So they'll do your website, they'll get your SEO optimized, they'll link into all your schedules, they'll let people book scheduling on your thing. They're rolling out one of the most exciting, which I don't know if we'll talk about now, Thryv Pay. They're going to handle your incoming payments, which I think is a really interesting opportunity. But that's really what to think about. I think mind body on that was more for gyms and stuff, but it's almost mind body for small businesses, the plumbers and HVACs. Am I thinking about that correctly?
Yeah, I mean, it even does stuff like, handles your back office. I mean, there's a time clock feature on it. I mean, there's something like 20 or 30 features that it does for small businesses. And I mean, frankly, I don't know all of them. I mean, it hasn't been really a reason for me to look at, I mean, I own the stock and the warrants, but, so I should know that a little bit better. But I mean, it's fantastic. And there are multiple different like kind of modules for it, right, that they've been developing, right? Because there was almost like a one size fits all thing. And they kind of realized, okay, something like, mind and body, right? It's catered for a certain industry, right? Or service type is kind of catered to HVAC or plumbing, right? It's a fantastic program, but I mean, I know some of the local firms here that use it, and one of them is a very big, like multi-city, Lexington, Louisville place that has, 40 vans in Lexington. They're not using it right. Like they literally have no clue what they're doing, and they have a big back office dedicated to that. Because it's so complex. And, so Thryv, they've got, kind of a contractor services portal that they do. They've got one that's HIPAA approved for medical practices, which I think is really kind of fascinating. Legal services, they're developing others. And kind of some of those niche markets, there could be some really compelling stuff in there over time, I think.
Perfect. All right. So I'm going to start off by saying, the first question I'm about to ask you is probably going to be a little bit of softball, but I think as we go into the questions, I'm going to ask some hard questions. And listeners who are familiar might say, oh, these questions are a little bit tougher than Andrew normally asks a listener. And Andrew must hate the idea. And they're actually going to be wrong. I'm actually really interested in the idea. So the reason I'm pushing back is because I'm interested. But I guess the first question is, when I hear you've got this software firm that's going after, small businesses and all this sort of stuff, and they're married to a dying melting ice cube yellow page business. And your first thought is, why is a software company and a yellow page business? Why are these two together? So why are these two together? I mean, John Paulson went on their Q3 earnings call and said, you need to split these off so we can get the value of the software business, right? Get that sweet software as a service revenue multiple. So why are these two businesses together? Why does that make sense?
So they developed Thryv, numerous years ago, and there's overlap, right? Because at the end of the day, a lot of these small businesses are advertising to yellow pages, so you can kind of cross-sell them onto the Thryv platform. And they got about 10% of those customers on the Thryv platform, which is really pretty impressive. It's just cross-selling services, and you can do a lot of stuff with that. New products and all that. And I think that kind of plays into their growth strategy with the Census acquisition, which we'll probably be talking about later. But I mean, they're different businesses. And I think that that's part of why the valuation is the way it is, because of the yellow pages business kind of obfuscating the SaaS. I do think that that's going to be rapidly changing though. And then there's this other part of the business that they talk about a little bit, which is Thryv Pay, right? Which is actually getting ready to, in the next couple of months, be a standalone payment platform, right? So is it going to be the next Square? Like, no, I don't think so. But we'll be able to do, hundreds of millions of dollars in unique payments. I think that that's probably in the cards, and I think that could be a good way to get more people on the Thryv platform.
And look, I mean, payments are the holy grail, right? Once you got someone in your payment system, it's really difficult to rip out. You can, every day you're getting more revenue, you're interacting with them. I mean, that is the holy grail. But let me give my first pushback here, right? You mentioned earlier, right when you're starting, you said, hey, it's sticky, right? You get the iPhone, and I've tried to switch off the iPhone before. It's tough. You get used to the operating system, and it's even tougher with, you go on Thryv, you integrate it with your QuickBooks, so it's going into all your accounting stuff. So I agree, it should be a sticky platform. but their churn it's pretty high, right? So I think my first pushback would be, hey, you're saying this is a sticky product. I'm seeing lots of churn here. And one of the reasons their churn is higher than a lot of the peers. We mentioned Mindbody as a loose peer. I think if you comp them to a lot of the other peers, their churn is a lot higher. And you could very easily say, hey, if you're churning higher, you deserve a much lower revenue multiple because you have to spend a lot more. Your customer lifetime value is lower. You have to spend a lot more to go acquire new customers to replace the churn. So first pushback, you say it's sticky. Why is the churn here so high?
Yeah, so there's a couple reasons. Historically, I think it's that they sold the product to some of the wrong businesses, and that's something that management has talked about a lot, and I happen to agree with it. When we were signing up for the product and talking about becoming a reseller for it, literally the first question that our sales rep named Carrie asked us was, what's your business size? What are your goals? Because we want to be sure that we are lined up and on the same page, because, if we can't provide you with the service that you want, we wish you well, but it just won't be a good fit for anybody. So they have taken that, and literally that's the first thing he said. It was basically like, why should I not sell you our product? So I think that they really have committed to that and getting with the right customer base, right? The other thing too is like a company like HubSpot. Yes, it is a better SaaS business. There's no disputing that. And yes, Thryv deserves a smaller revenue multiple than that, I think. Because big corporations or that Salesforce would sell to, things like that. That's they're probably going to stay in business more than like your local HVAC firm, right? I mean, they start over all the time. That happens. I mean, what's the stat? 50% of small businesses fail in the first 3 years or something like that. I don't know what it is, but I know it's a high failure rate. So I think you're going to see that with the company. But another thing on the upside for that is that generally entrepreneurs are serial entrepreneurs. So they fail, they start up again, they fail, they start up again, right? So like, with the example of my iPhone, if, I break this iPhone, am I going to go switch to Android or, whatever other software platform or whatever there is? No, I'm going to get another iPhone. So if I start up another business because I failed, I'm probably going to go to the software that I already know. The other aspect of that for the high churn rate, I feel like, is that a lot of small business owners are generally unsophisticated with software solutions. It gets back to that, being in an ass-kicking contest with a one-legged man, right? I mean, a lot of these guys, they wear so many hats. They're their own bookkeeper, they're their own secretary, they're their own salesperson, they're their own installer. They've got to collect bills and all that stuff. They've got to manage their handful of employees. And, a lot of these, in my experience, a lot of these contractors and my view of the company is heavily based on contractors because I do a lot of real estate. So yeah. That's my bias, I guess. But they're wearing a lot of hats. And so, sometimes something as simple as responding to an email is a big time commitment for them, or they feel like they can't because they're so overwhelmed with so much stuff. So when it comes to like kind of perfecting things with a software that really does make their life simple, over the long term, they're really worried about making payroll for Friday. So they may not be thinking, I need to be doing this marketing campaign where MailChimp is linked up with Thryv. They're probably not thinking about that. They're, some of these guys live hand to mouth. And I think that shows with when they may drop the software.
Angie's List, which is a company I've done a podcast on, I've looked at a lot. That's one of the things they always say. They're like, hey, look, a lot of our plumbers, they don't care that we say, hey, you're spending $200 on our platform and you're getting $2,000 of business off, your ROI is 10x. Obviously there's costs and stuff associated with revenue, but this is an incredible marketing tool for you because the plumbers aren't looking at it like that, right? They're saying, hey, I just gave you $20 and I didn't get any lead from that, because some of the business would be you're one of 3 plumbers lead. And they're looking at that as money burnt, right? They're not looking at the total cost. And I don't think it's because they're dumb. I think it's because these plumbers, they actually have to go do plumbing. They're spending their time plumbing. They're not looking at sophisticated ROI models for this thing. So that makes sense. Who's the big?
I think there's going to be a generational shift with that. I genuinely think. I mean, you can see with the adoption of iPhones and like just how people email better now than they used to. I mean, everyone used to hit reply all on an email for a company chain, and now that's like a thing of internet memes where it's like, God damn it, why did they do that? And even with group text, right? I mean, my parents will get in a group text and they think that they're texting with one person and they're actually texting with the group. And I think that there's going to be some spillover into the acceptance of CRMs and, SaaS businesses, especially as there's just that natural progression. It's kind of like the people that used to be using the yellow pages to find a plumber now go on Google, right? And then I think the next generation will be more apt to get on something like Angie's List rather than just do a Google search. So
Thryv, when they're going and, when your contract buddy or whoever is looking at the software, who's Thryv's competitor in the I'm going to call it the super small business, local business type space for this CRM? Because I doubt it's a HubSpot, maybe MindBody, but who are the other options here?
So again, I'm going to be heavily biased towards construction.
That's fine. Yep.
Yeah. So Jobber would be probably the closest competitor that I can think of. They're really contractor businesses though. I mean, you couldn't run like a hair salon or something on Jobber, which you could with Thryv. Service Titan, like I was saying, like that's probably the one that everybody knows about that'll be watching this. That's a much more complex software. That's not what Thryv's set up to do. They're not even trying to compete with that. So yeah, I mean, I think that Jobber would be probably the main one. I'm sure that there are several others. There are probably some pretty niche players. And my diesel mechanic, right? I was talking with him about the software he used, and he talked about how his son was getting him on like Garage Medic or something like that. It was something that I'd never heard of that, probably doesn't have many users, or maybe it does, I don't know. But I think that there's probably some pretty niche products. Like my firm, my contracting firm uses Co-Construct, and we really like that. And there's some overlaps with it with Thryv, but personally, I would really like to see them partner because there's some really interesting things they could do together, especially with all the data Co-Construct has from subcontractors that could benefit from Thryv, and you could get like cross-linking of the platforms to do payments and stuff. But yeah, I mean, Jobber would probably be the main one, and I'm sure that, like I said, I'm sure that there are others.
No, that's perfect.
Nothing. I don't think anything is as general as Thryv.
Let me put a different tack. So as an investor, I hear you coming and you say, hey, I've got a great idea. We're going to invest in Thryv, right? It's a former Yellow Page company, or I guess current Yellow Page company, but the sexy stuff is kind of in the software as a service, though. The majority of the value is probably still in the legacy stuff. But when you say that, my first thing is I have heard people pitch former Yellow Page companies for over a decade at this point, right? And all of them go bankrupt, and then they emerge, and then someone new pitches them, and guess what? 3 years later, they go bankrupt again. Because these things, they are melting ice cubes. You said it. It might be a melting glacier, might be melting ice cube. A lot of that is because many of them were dealing with debt structures that were set in 2005 when the Yellow Pages were a much better business. But I've seen them chapter 11, chapter 22, for some of them chapter 33, right? So when I say that, the first thing that pops in my mind as a roadblock is like kind of pattern recognition. Former Yellow Page companies go bankrupt. And I think if we're going to stop generalizing a little bit, I do think there's probably a lot of brain drain, right? Like Thryv, we'll probably dive into this pushback in a little bit, but Thryv is trying to build up a software as a service startup type growth company. And if they're competing for an engineer and they go to, the engineer who just graduated from Stanford, and they say, we'd like to give you a job, and he's got a job offer between a former Yellow Page company and Google, pretty obvious what he's going to go with. So I'll turn both of those concerns over to you.
Yeah. So to talk about the latter point, they're run as two distinct companies. I mean, and they're starting to break that out of their financials. They just literally filed their first 10K as like a post-bankruptcy company, right? And the only filing before that was a 10K. So they're breaking that out. They're run as two separate companies. They could hypothetically split them off tomorrow. Their debt makes that a little bit complicated because of the new bond offering they did, but they could split it, And so I think that that's also part of the rebranding with calling it Thryv. One of the things that I would probably do if I was pitching this, I would generally want to talk about the SaaS first, and then be like, oh, by the way, there's this Yellow Pages business you get for free or something like that. Yeah, so, and to be fair, I mean, Dex Media, the predecessor to Thryv, did go bankrupt. I mean, that's why the warrants that I hold exist, is because a lot of the debt holders got warrants in exchange, because the equity was totally wiped out. So I'm going to knock on wood with both hands and say, this time it's different, hopefully. they've delevered a lot. They paid off a lot of debt. They recently did a debt refinance. They actually just funded an acquisition with some of the debt with Census in Australia. They bought it at like 1.5 times EBITDA. And they've got a lot of points in the debt covenants that make them repay the debt, right? And then, so they're pouring money back into the debt. And I could go through the slide presentation here to see the exact amount, but I think they paid back, something like $200 million in debt or something like that in the past year. I can't remember the exact number, but it was a lot.
Yeah.
And as they get that debt pay down, you kind of get the virtuous cycle of, hey, you're paying less interest on the remaining debt. So, you pay off more principal. Right now, their debt is scheduled to be paid off in 5 years. I think the company their goals, or at least what IR has told me, they're hoping to do it in less than that. Another interesting point, I keep talking about these warrants, but these warrants, let's walk through the mechanisms of them because it has to do with the debt ultimately. So as you all know, a warrant is basically a call option that's issued by the company, right? And so there's, going to be capital injected into the company if the warrant exercise price is met, all things equal, right? So right now there's something like 10.5 million warrants. They convert into about 5.5 million shares of stock, right? And the exercise price is $24.39 a share.
So right around current price.
Yeah. And again, it's about a 2-to-1 ratio for the warrants to shares. And they have until August the 15th at 5 p.m. of 2023 to exercise, right? So we're 2.5 years out on this basically. And I think it's a pretty compelling bet, right? I think it's a very levered bet, even though there's no market for these things. And we can get into how I kind of got them later if you want to go down that conversation rabbit hole. But if you look at the exercise price of $24.39 a share, multiply that by the roughly 5.5 million shares that would be issued for that, there's going to be about $141 million injected into the company. And this is a company that has about $700 million in debt right now, or as of the bond offering, right? And they've probably had some pay down in the past, couple of weeks, So you start looking at that, it's like, well, if they get $141 million sometime in the next 2 years, with the cash flowing business, with the EBITDA profitability of the SaaS business, that starts to look pretty compelling. And I think gives you a pretty good margin of safety for if they kind of run into an, oh shit, we miscalculated the revenue decline. Because that is a risk, but I think it's an acceptable one from my perspective.
For me, it's just a financial engineering bridge too far because you get super circular, right? Like every time I've ever seen a company, I remember AMC actually did manage to split off, but every time I've ever seen a company that had converts that were in the money that said, oh, we look at that as a equity piece of our capital structure, that's permanent financing. Almost invariably, the stock is down 50% 6 months later, the debt is way out of the money, and they have to figure out a way to pay it back. So to me, like, just the warrant financial engineering piece is actually the least interesting part of this piece. Though, obviously, if you're really bullish on the software as a service, the business gives you a lot of operating leverage to, right. I'm never going to make that motion again on this for the YouTube subscribers. That's my bad. Let's see. Let me give you another pushback. So go ahead.
But yeah, that's the thing. If you're bullish on the stock, then like the debt is a feature. Right.
Yeah, I just meant as the financial engineering, as cash coming in from the warrants, it's a less component. Let's do the fourth pushback. Some of the parts, right? I think you're very bullish on the company. Why don't you lay out some of the parts? Obvious software as a service business, you slap a multiple on it. The marketing declining business, you slap a multiple on it. Get to some of the parts. How do you look at some of the parts here?
Yeah. So a lot of it depends on what happens, right? They just did the Census acquisition that's going to bring them a considerable amount of revenue, and I ultimately think it's going to bring them a lot of clients. So that's potentially an unknown, but I'm giving them the benefit of the doubt because again, like I generally buy the story, right? So I kind of think that the Yellow Pages business is worth at maybe a little bit below the EV of the stock, right? And I'm saying that not because of the private party buyout amount for it. I'm kind of saying that just hey, I think that you'll have the debt payoff, and I think that there will be cash left to harvest to kind of compensate you for your time, the time value of your money, and then so I think that's worth about what we're at right now.
So I'm just doing the math as we speak. So 2020, the legacy Yellow Page business did about 350 million in EBITDA.
Yep.
So you're saying, hey, I think that legacy business is worth 2.25 times EBITDA, which would get you to about $800 million in enterprise value. That's about the enterprise value of the company today, if I'm doing my math right. Am I doing? Nope, I'm not doing my math right. I'm missing the.
Like 1.2.
Yeah. So you're thinking that the enterprise, to get that, you're thinking it's kind of worth 4 times EBITDA, if I'm doing my math right here.
I mean, I'm throwing in census too, right? Because I mean, census. I mean, that's throwing in some extra EBITDA to that as well. So, and they paid 1.5 times EBITDA for that, and it's a pretty efficiently run business.
Yeah. So actually, that's my first pushback, because I really like the census acquisition, and we're going to talk bull case for the census acquisition in a second. But I think my first pushback was hey, we just talked, and you're some of the parts you said the Yellow Page business is worth 4 times EBITDA. They just did an acquisition, and I was reading some quotes from the CEO, and he said this is our Yellow Page business just in Australia. They just did an acquisition at about 1.5 times EBITDA. So why are you telling me the Yellow Page business is worth 4 times, where I can say, hey, they just went and bought a whole business for 1.5 times EBITDA, right? So, there is a valuation mismatch. How would you think about that?
Well, I mean, so with Census, there was a private equity firm that was kind of looking to dispose of it. And I mean, who wants to buy a Yellow Pages business? I mean, the exact reason for your pushback is kind of why I think that there's, and rightful pushback, right? I think it's correct. I think that kind of makes there be a market discount. And I guess I just fundamentally disagree with what the market's valuing stuff at. I think that it'll produce cash over time. I believe the story, and I think that there's going to be something there. And I mean, this is something you see with rural telcos or regional ISPs. I mean, the market value is never there, but they keep producing cash flow over time, especially when you get them on a highly variable cost structure to go along with the revenue decline, which Census and Thryv have both done. So and comp for this is Yellow Pages Canada. Right, that's a public entity, and you can see where they kind of bucked the trend of the bankruptcies and stuff. They will be per their last filing, they're going to be paying off all their debt as soon as all the prepayment penalties and stuff are done, which is the 1st of May or the end of May 1. They're declaring dividends, and frankly, I think they're prepping for a sale right after that, and I think that Thryv's probably going to buy them. That would make a lot of sense. I mean, it goes with the English-speaking country aspect of Australia. It goes with the good management. You can add on Canada, keep the remote work. There's commonality in the language. SaaS businesses could I think really thrive, for lack of a better term, in Canada. So I think that seeing the Yellow Pages Canada buck that trend helps, and I mean they've been shareholder friendly. So yeah, I just think that there's a private party market.
I agree with you. I think Yellow Pages Canada would be a great acquisition, but let's finish with some of the parts, because then I think it'll help us dive into why the Census acquisition was great. So we both just said, hey, call it 4 times EBITDA. That gets you on the marketing business. That would get you about $1.5 billion of value from the marketing business. That's about the whole enterprise value. So that covers one piece of the sum of the parts. The other piece is the Thryv business that you're so excited about, right? So aiming for about 140 to 145 million in revenue in 2021. How do you think about valuing that part of the business?
I mean, if you throw a 10x multiple on that, which is what Paulson was talking about on the conference call, that's another $1.5 billion right there. So that's substantial. HubSpot, again, it's a higher quality SaaS, much stickier. Their churn rates are less than half of what Thryv's will be on a good day, probably. But even if it's a 5x revenue, still kind of compelling. I tend to think that there's going to be more growth there and more revenue than they're talking about, in part because I think they're getting their average revenue per user up. I think ThryvPay is going to help a lot with that. I don't think you're paying anything for ThryvPay as the payment processing platform that will be standalone, which is compelling. And then Census. I mean, for some of the math on that, so let's say Census has 100,000 customers right now, which is a little bit low, but let's just make it easy. So you got 100,000, and let's say they get a 10%, conversion rate, which is exactly.
Are you using a calculator right now?
I am. Yeah.
This is old school. I love it. I love it. He just showed a real old school. What's that calculator called? I can't remember, but he showed a real one for those who are listening on the podcast.
Yeah, I don't know. It was like $8 on Amazon. I love them. Big keys.
I respect it.
Yeah. So anyway, if you get the 10% conversion rate that the Yellow Pages had, and this will take, a year and a half, 2 years probably, maybe a little bit more, but I think it'll happen.
And I was going to save this for the end of this. They said, hey, we bought another Yellow Page business that didn't have Thryv. I think it was 2017 or something. And within 2 years, we got 10% of their customers onto the Thryv platform. So you're not pulling 10, like when I first read your piece on it, I was like, he's just pulling 10% out of nowhere. That's a pretty big assumption. They've got a track record of having done this. So I just wanted to support your point there.
Well, thank you. And the other thing too is SaaS adoption in Australia is lower than it is in America, right? So I think that may actually help them a little bit in terms of getting more people up, just because Australia may be a couple years behind, so it would stand to reason they would catch up. So anyway, so let's take their average revenue per user and multiply it by the 10,000. They're getting $290 a month roughly. So that's not right, is it? Yeah, okay. So it's 2.9 million a month times we got 12. So that's 34.8 million, call it 35 million bucks in additional revenue. So the Census acquisition alone is going to give them what, 30% growth, right? Yep. On top of what they're already guiding. And so they're paying $200 million for this thing, right? 200 million divided by 35 million. So that's 5.7 times revenue for the users they're getting. And that's if you value the cash flow of that business at 0.
Yeah, so
I don't think it's right.
Hey, we bought this legacy Yellow Page business for a fair to cheap price, 1.5 times trailing EBITDA or something. And then because we have this Thryv product, we got all the optionality from that for free. And as you're saying, if you do the math on if they can hit that 10% mark again, I mean, they could create theoretically $200, $300, $400 million of software as a service value from this $200 million acquisition that, by the way, is bringing in cash flow the whole time from the legacy product. So that's what I was trying to, and that makes the point I was going to say, like when you do the sum of the parts, we're going to value it as, hey, software as a service, 5x revenue is worth one thing. Marketing 3 times, 4 times EBITDA is worth another. That's going to get you to one value, but it misses the synergies between the two businesses, and especially the synergies between, hey, we go by census. Hey, we go by the census of England. We go by Yellow Pages in Canada, and we get these synergies over and over and over again. And by the way, as we do that and Thryv gets a little bigger, maybe that revenue multiple goes up a little bit because it's a little bigger, or maybe it gets some operating leverage to the revenue. Like there is a real synergistic 1 + 1 = 2.5 play here, is I guess what I'm trying to drive at.
Yeah, and so like let's say that they're paying 1.5 or 5.5 times revenue roughly for these customers, right? If you value them at a 10x multiple, right, that's pretty accretive, right? And then like something like HubSpot, a couple years down the road may want to come in and buy Thryv, right? So they can issue stock at 20 times revenue, buy a company for 10, 12. It's immediately accretive for HubSpot. Kind of makes some sense. Maybe it's not in HubSpot's interest to do that. I don't know, but I'm saying it's a possibility that can get you some really wild prices for that. But just being reasonable with stuff from a ground level and just thinking of this from a purely value play, it's still very cheap because of all the optionality. Now, the other thing too is that Joe Walsh, the CEO, he has a history with doing this sort of thing, right? He came in and took over Cambium.
Let's talk Joe Walsh in a second because I do have questions on him. Just for people, we were throwing a lot of math around. You can correct me if I'm wrong, but if I said the software as a service business is worth 5 times revenue, that would be worth 700 million. If we said marketing legacy Yellow Pages is worth 4 times revenue, 4 times EBITDA, that's 1.4 billion. That would be a 2.1 billion EV. That would get us to, I think, about a $43 stock. And obviously we haven't given them upside from census. We haven't given them, maybe the 1 + 1 = 2.5 we talked about, but I think that's reasonable-ish. I don't think I've adjusted for warrants there, but it wouldn't be a huge adjustment at that point. Is my math, would you push back hard on any piece of that math or anything?
No, I have no pushback on how you did that. I mean, if I had pushback, it would be like I personally am ascribing value to census, right? So, like me personally, like as it sits, because I do believe the census story, I think as it sits, it's worth probably $60. But I buy the census story, and I get that some people, they want to see the numbers before they give them a value. But I mean, the market is a predicting force ultimately, right? So I'm kind of predicting that with my valuation. And then again, there's that's not giving credit to any potential consolidation of the industry, like in England or something, because and we'll wait to talk about Joe Walsh, but part of the Census acquisition, he'd known the head of Census for quite some time. They'd met in person, they'd done some sharing of processes, I believe. He talked about on one of the calls. Joe Walsh is really well connected in this industry. He's been to England for stuff. I mean, he's well connected. So if there was going to be a deal maker to make this work and kind of roll this stuff up to get this really neat, almost like buying the land and getting the timber or the oil underneath of it for free thing, Joe Walsh is the guy to do it.
Great. Well, let's talk Joe Walsh. That's a perfect transition. So, I think a lot of investors who listen to this are going to think back to Cambium. It was ABCD when it was publicly traded. And a lot of people made a lot of money following him into that roll up and eventually selling. I'll let you go into that story. But, I am of two minds here, right? Because I think Joe Walsh has a good track record. I think he's executing the right strategy here. But at the same time, he's been the CEO of this company since 2014. Obviously, there was a bankruptcy 2016, 2017. I don't think you can throw all of that on him. But, he's been here for 7 years. They're trying to do a software as a service startup. Why, when you say all that, I do think, like, why is this guy the right guy to lead this business? And, Andrew and Jeff are talking so highly of him. He's been here for 7, 8 years. We've had a bankruptcy. Are we putting a little bit too much shine on him?
Maybe. I mean, we could be. But I want to bet on him. I mean, he's got, like you said, he's got a great track record. And I think part of the track record is at Thryv, actually. I mean, they've already made back all the money that they've invested into the SaaS business, right? They're generating positive cash flow from it in EBITDA. I mean, they very clearly highlight all this in their presentations, which all of their presentations and like their Stevens conference and all that stuff are great things to catch you up. But their new conference call, it was actually yesterday with their 10K release, was really good. They have a really nice presentation that I have pulled up here in case I need to reference it. But they grew a SaaS business from 0 to 45,000 subscribers, right? Over the course of, 5-6 years, something like that. That's impressive. And the company, the SaaS business is generating cash flow and profits. They aren't running the thing at a loss because, there were a bunch of distressed guys that control the board. They've since kind of realigned the board a little bit, got some more software people in there. But this was not going to be a money pit where they just kept, like a Blue Apron would have been or something where they're like, well, we need to get these customers and it's just growth. We don't care about anything else, So they cared about cash flow, and I think that responsibility that they had in that kind of shows the business acumen the guy has. I mean, that's not something, and they haven't issued a ton of equity. I mean, they bought back a bunch of shares. They did that about maybe 9 months, a year ago, something like that. So he's just he's kind of a different cloth than a lot of these SaaS guys.
Because he had a quote, and I tweeted this out, but it was a quote, something along the lines of, they got that board refreshed last year, and the board of directors came in and they said, what the hell are you doing? You're making too much money in your software as a service business, right? Which, hey, that's just a great quote. I would love somebody to come in and be like, Andrew, you're making too much money, dial it back a little bit. But, it's a cute quote. It's really interesting. It speaks to, hey, we're switching Thryv from we're switching it to a bigger growth category, right? We're going to reinvest into it. But at the same time, when I say, hey, this guy's been CEO for 7 years and he was running Thryv for cash flow for all these years when he had this huge opportunity, you can see why it raises some questions in the back of my mind.
Yeah, I can see that. I mean, he's kind of zigging when others might have zagged, I mean, that's the fair point. But, at the end of the day, with small business software, the time for the growth period for a lot of those companies is right now, right? It's not 5 years ago because small businesses were not on like CRMs and stuff. I mean, that's a relatively new thing. I mean, and you can see that with just the adoption of text messaging by people and, cell phones and people emailing.
Zoom.
Yeah, exactly.
Yeah. Nowadays, you say to anyone, hey, let's hop on a Zoom call. Everybody's ready. 18 months ago, a lot of people have been like, why are we, what?
Yeah, my mom does aerobics over Zoom, right? And my mom, like, my brother affectionately refers to her as a virus for like cell phones and anything computer related. And she can do Zoom now. So I think that there's that same sort of corollary with small business getting on these softwares. And so, I think it was smart to run profitably for the time, kind of zigging when others might have been zagging. And they ultimately stayed solvent with all their debt load. So there does need to be some credit for that, because they navigated a lot of debt pay down and a lot of debt payments. And, I think they're kind of reaping the rewards of that right now because they were able to raise $700 million of debt to kind of fund the Census acquisition. And granted, it's junk debt right now. It's rated at, whatever junk debt's rated at, and, they're paying, 8.5% or something on it. But they did get their interest rate down some. And, the terms were relatively similar to a debt offering that Gannett recently did, which, the Apollo guys are involved with that, right? So, there's some industry corollaries and stuff.
Let me give you my last pushback, because I'm sensitive to time and I want to have time for you to just give anything else on your mind that you're thinking about. But, I think my last pushback would be Joe Walsh, CEO, comes out and buys $4 million worth of shares on the open market week and a half, 2 weeks ago, something, right? I think he bought it for $18 per share. And obviously that's a hugely bullish sign, right? The CEO coming out, writing $4 million check out of his own pocket. I'm with you. At the same time, I'm just looking at the insider sales. Moderate Capital, Paulson, Golden Tree. I mean, they have been hammering the stock over the past couple months, right? You and I are bullish. We're doing some of the parse math. We're saying, hey, this marketing service business, huge cash flow, huge hidden gem in the software as a service business, tons of equity value underneath this. At the same time, they're not super levered. They go to a really accretive acquisition, not super levered, and they're rated junk. They're paying huge interest rates in today's market and everything, right? So you can see the bullishness, but at the same time, super sophisticated investors bailing out. Rating services, debt investors, everything, they don't see the margin of safety that we're kind of talking about here. So what's the discrepancy? How do you think about that?
It may not necessarily be that they don't necessarily see the margin of safety. It's just that this type of investment isn't what they do, right? I mean, these were distressed debt guys that bought all the debt in bankruptcy, right? So if you're a distressed fund, and then like all of a sudden, and that's kind of the cloth you're cut of, it's a really big transition to go to, hey, let's cash flow this thing, and then let's grow the SaaS business and do this other thing, right? I mean, it's with the houses I do, like we buy houses that are falling down and we rebuild them while they're still standing, right? And sometimes it probably would have been better to tear it down and do a new build. But I'll be honest, like I have no intellectual fascination towards doing a new build. Like I would never do a development out, in green space. Like I don't want to do it. Like I could make a bunch of money doing it, and I wouldn't do it because I just don't want to. And so I think that it might be something like that with some of these debt funds. Just not what they do. And it's probably a large position for them too. Mudrick's stock right now is probably valued, this is a swag, but maybe 400 $million, something like that. He owns maybe 60% of the company. So that's a pretty big amount of money for the funds that he's got it in. So I think it would kind of be responsible for his investors for him to kind of reduce the exposure a little bit. Me personally, right? If I had 80% of my stock in a company, it's still possible for me to be bullish on the stock, but be selling it just from a risk control perspective.
Yep.
I think that's something that's missed by a lot of people with that. The other thing too is, Paulson, he seems to be pushing for a spinoff of the SaaS. I originally had that as part of my investment thesis was, hey, this thing will be spun off for 10 times revenue or something like that. And that's a big catalyst. And the more that I dug into it, I started to really like the SaaS and, think that there's a lot of growth potential there to really do some compelling things. And so, maybe Paulson was doing a little bit of spite selling or something of that nature. Some people on Twitter were calling him Paper Hands Paulson for whatever reason. I don't know enough about his track record to make a comment on that. I always thought he was pretty smart for figuring out the subprime crisis, but maybe he's wrong on this. I don't know. But the other thing too is like funds, they can't have, I think the other side of that is you need to have less insider ownership, of this controlled entity, basically, for other funds to be able to invest in it, that really understand the SaaS business, so that the company can be re-rated by newer investors that understand the SaaS business.
Yep.
And, there are liquidity requirements for a bunch of funds and stuff. So, I think that there does need to be some shareholder-based turnover for that. And, ultimately, like Dex Media was on, the Russell, and it was on indexes and ETFs and stuff. And it's just a matter of time before Thryv gets picked up by that. And I think that they're trying to get some of the insider ownership down so there's some more float so that it can be on more ETFs, more in more mutual fund baskets, et cetera, et cetera. And then there can be some really compelling things happening. But again, I kind of view that as a forward-thinking market mechanism, right? Because, if you wait till that happens to start buying the stock, the opportunity is going to be gone. So I'm willing to deal with whatever happens for the next year or whatever it is. It could be 2 months, it could be a year and a half. I don't know. But I think that ultimately the market will realize kind of the mistake that is made with this low float stock.
Yeah, no, look, I don't disagree with you. I will just throw two things. A, Paulson going on and asking them for a spinoff. Like, I certainly get it. If you think this stock, I'm just going to pull a number. If you think it's worth 50 in a split and it's currently trading at 20, yeah. I obviously see the desire to get that short term, split it and grab it. But at the same time, as we talked about, I do think 1 + 1 = 2.5 here. And I do think it would be very like short, penny wise, pound foolish if you split them up right now, right? Like, again, the census thing. What if they get 10,000 subs from Census and they basically acquired all of them for free because they bought the business at a fair value for the elevator? So I think that in the long run, I'm sure that happens, but in the short run, I think that's cutting off your nose, your face. And then the other thing I'd say, like, I definitely hear you, like Mudrick's distressed, Paulson's distressed. It always does worry me when you've got a guy who owns 60% of the stock and he says, hey, I'm leaning into this stock to get rid of it. It's just a concern. It's just a concern. And I do hear you. It's a different thing than what they do. But, we're here saying some of the parts 40, stock 20, and the larger shareholder saying, let me get out of my stock. No disagreement. I think we've covered a lot here. Again, I'm asking tough questions because I was interested as I dug into it and really read those reports. I was getting more and more interested in it. But I want to turn it over to you. Is there anything, you think about with Thryv that you don't think we hit, that you wish we had hit harder? Any last words you want to say here?
Let me look at these notes real quick. No, not really. I mean, it makes up something like 50% of my portfolio between the warrants and the stock. I mean, I'm crazy bullish and have a bunch of concentration in it, which is, either going to make me look really smart or really stupid. So we'll see.
Well, I think it's going to make you look really smart. As I've said, I haven't gotten all the way on it yet, but it is a really interesting story. And, I guess the sticking point, as I said at the beginning, I do have, hey, I had that like 1 year from now writing a letter and saying, hey, we invested in a formerly bankrupt Yellow Page company and they went bankrupt again. I've got that in my mind. But on the other hand, I do have all the things where it's, hey, there was this dying legacy business, but it had great customer distribution, relationships, cash flow, and they used it to evolve into something so much bigger that, we went from trading at a 2x EBITDA multiple to something that should be valued at a 10x revenue multiple, So I've got both those in my mind. I think it's a super compelling, interesting thing. I'm a little nervous that I'm going to post this podcast and destroy the opportunity, but that's, everyone should do their own work. That's okay. Jeff Moore, great to talk to you. Appreciate you coming on the podcast. Looking forward to the next one. Thanks again.
Thanks for having me.